Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Tuesday. It's November 8th. It's about 8:23 in the morning. The market's going to gear up to open at about an hour and 7 minutes to be specific with you. Now, as you can see here, the Dow's up about 73 points. The Nasdaq is up about 43 points. We are still abutting the 200-day moving average on the Dow Jones, as I'll show you right now, which means markets are really becoming overbought, like really overbought because, and I'll explain to you practically, we're above the 200-day moving average. The odds of us staying above the 200-day moving average in this market economy, with the RSI being where it is very slim. This would mean we would move into positive territory. I don't think we're there. I don't think we're anywhere near there, and I think this market's going to undo most of this upside and correct the downside in the next few days after this election is over. And that's the big thing today. Not a lot of Fed data, but a lot of election data. Volatility looks like it's turning. It looks like it's bottoming out around here, and looks like it's going to start heading up again. And if you look at the bond market, which we will right now, the bond market continues to go down, puts more pressure on tech and sectors such as technology. Fed calendar's pretty empty today. Not a lot of data, a lot of looking into the election, and that's really the big factor. And everybody's gearing up for the CPI on Thursday, and we'll talk more about that as things continue. I think we still have earnings for big companies like Disney today and so forth. Let's look a little bit at the pre-market action. So market was being driven yesterday by oil and gas, technology, and industrial stocks. Now, oil and gas, I get. Industrial stocks, I get. Technology makes zero sense, except for the fact that technology could be a little bit overdone following the nasty earnings that we saw on the FANG stocks last week. Ahead in Tuesday's session, markets participants will be closely eyeing the outcome of the midterm election, which could potentially herald change in the country's economic policies. Don't hold your breath. It's not going to happen overnight. Republicans are favored to win a majority in the House of Representatives in the election, with the Senate rated a top-up by nonpartisan forecasters. The likelihood that the Republicans take the House or the Senate is pretty high, therefore guaranteeing some form of gridlock over the next couple of years. Oh boy. That would probably take tax hikes off the table and any sort of big spending potentially perceived as inflationary off the table. Meanwhile, U.S. rate futures have priced in a 52% chance of a 50 basis point rate hike and a 48% chance of a 75% rate hike. The numbers was actually higher, favoring a 0.50 up till about a few days ago. It looks like the numbers are now starting to get more neck to neck in terms of 75 versus 50. I think one of the biggest factors is the fact that Mr. I won't be honest with you till I get reappointed Powell used the word lag, the fact that they have to take into account lag, and that could mean that they want to take into account a little pause or lower the basis points. But honestly, after 3.75 rate hikes, it would seem like backing off would be the thing to do. In China, today closed lower as traders dialed back expectations that Beijing would lift COVID restrictions. Oh yeah. Chinese authorities said over the weekend that the country plans to unswervely stick to its zero COVID strategy, dismissing rumors of a potential removal of restrictions. That's not good for their economy. Uncertainty over China reopening has heavily affected investors' appetite for the country and other countries because, look, I mean, they're huge. TripAdvisor came with bad numbers. Lyft came in with bad numbers. Take-Two came in with bad numbers. LivePerson actually came in with good numbers. Lyft, things are not looking good for consumer stocks. That's why we're short all of these consumer stocks. That's the first report. The second report I wanted to show you was more detailed about the election. Control of the U.S. House and U.S. Senate are up for grabs, with a huge number of voters expected to turn out, potentially leaving the U.S. government split between Democrats and Republicans. Every seat in the U.S. House of Representatives is up for election this year, along with about a third of the Senate. On the line is control of both. The House currently under Democratic leadership. I don't think that's going to be it for much longer. Voters are also electing governors in most states. They'll be in the office in 2024 when the next presidential election happens. A divided government would likely bring gridlock. rather than big sweeping policy changes, and that's exactly what I'm thinking is going to happen, which isn't going to cause much of an impact, positive impact on the stock market. Analysts say a strong performance by Democrats in the election could lead to increased spending to control the economy that might fuel inflation and leave the Federal Reserve obliged to continue to hike rates. I hope that doesn't happen. Higher rates slow things down and are not fun for anybody. So I'm actually hoping that Republicans, sway a little bit. The big news this week is going to be the CPI. That's coming out on Thursday. And we're hoping that finally, the number is going to be a little lower. Reporting season is done for all intents purposes with 85% of companies already reporting. And so far, numbers are slightly better than expectations, but most of those expectations have been beaten down to death. Now, put to call ratio is finally below the threshold level, which means that the market's actually a little bullish now. And as I showed you, the Dow Jones is now trading above the 200-day moving average for a few days, which I do not think is going to last. And I think this market's going to huff and puff and come back down. Matter of fact, I want to show you some of the stocks we're short right now. Most of them are consumer stocks like Magic Mountain, Marriott, stocks that typically don't do well when consumers, Norwegian Cruise Line, these stocks typically don't do good in an inflationary environment. So again, and look at this stock, look at Norwegian and look at the Dow Jones. I mean, they look almost identical. So I think the Dow is just a little bit overbought, and I'm expecting the broad market to start cooling off. In terms of sectors, I would be very cautious with you because look, we still have 273 stocks making 20-day highs and only 52 stocks making 20-day breakdowns. So you got to be very nervous that we're a little overbought. But again, if you look at the sectors, you will find that energy, industrial, financial, healthcare, and consumer staples, it's actually pretty defensive right now, is leading. And I would definitely stay within these sectors. Basic materials and utilities too. I would not go long technology, real estate, consumer discretionary, or communication services. And when I say consumer discretionary, there's a lot of stuff in consumer discretionary that's related to going out, amusement parks. Consumer discretionary is not just Amazon and Microsoft, okay? So keep that in mind. Very important. If you look at the chart of these, energy looks like it's still got strength. Industrial looks like it's got strength. Financial looks like it's got a little bit, not too much. It doesn't look like it can break above the high there. Healthcare looks like it's okay. Technology looks like it's right at the bottom here, which means it's actually consolidating, which isn't that bad. Basic material looks like it's got a nice little trend going on. Consumer staples looks like it has a chance to break out. Real estate is just kind of sitting there doing nothing. Consumer discretionary is literally at the bottom, along with communication services that's trying to rally to the upside. Now, where's my utilities? Where's utilities? You got to be careful with utilities, but at the same time, utilities can't underperform energy all that much because energy prices are going higher. And if you think your power company is going to not pass it along to you, I've got something in store for you. They are. So keep an eye on utilities. But quite honestly, I really like the sector grid map right now. I like the fact that most of these stocks that are up are in fact defensive stocks, and you've got technology, real estate, consumer discretionary, communication services on the bottom. If you stick with that, you should do okay throughout this. As I mentioned, the put to call ratio is finally below 90, and every time we've been coming down, especially from 136 to 88, we tend to back off, and we are overbought. Also, and this is really important, and I pointed this out to you guys last time. Look at the 200-day moving average. There's a lot of red here. And when you look at the green, 52%, 56%, but look at the 50-day. It looks like they're starting to gear up a lot. That's danger. You want to see the 200-day green up a lot, not the 50-day. Right? This is very swing trading. This is fundamental. And fundamentally, you still have 38% of stocks in the S&P trading below the 200-day moving average. In the Dow, you have 32 stocks trading only above, not below, above the 200-day moving average. And on the NASDAQ, you have 28. So fundamentally, the foundation is very nimble right now and weak. And to me, outside of energy, outside of consumer staples, outside of industrial, and when I say industrial, That's the defense companies, the Lockheed Martins, the Rayons. That's where the money is. So you got to be really, really careful and very cautious because this market can turn on a dime. Now, strongest sector right now remains energy. Weakest sector, as I pointed out to you, remains communication services or consumer discretionary. They're both, I mean, look at this. They're both like just mimicking each other. 16%, 17%, they're right there. So anything in consumer discretionary communication services, I would sell right now, unless it's been beaten down to death like Facebook or Meta now that it's called. And I still like energy and industrial. So let's look at the S&P 500 because today is Tuesday. And on Tuesday, I always give you the strongest stock, strongest sector, weakest stock, weakest sector. So it's real simple. Here's your choices. I would go with SLB, ConocoPhillips, Hess. Is Hess a, hold on a second. Is Hess an energy stock? 1 second. I should probably know this, but let's see here. I think it's also, yeah, energy. Yeah, refinery, of course. What am I thinking? It's still early over here. Yeah, so SLB, COP, HES. Now, this is a medical company. This is also a medical company. I told you biotechs and medical stocks would start rocking and rolling, but then again, you got into Marathon Petroleum. Healthcare and energies. Healthcare and energies right now, folks. I'm telling you. And if you look at my modified scan, it'll show you exactly the same thing. Oxy, Marathon, Apache, Marathon, UNM, Hess, same stocks, nothing different. Schlumberger's down here, but honestly, Occidental, MRO, Apache, these are all Devon Energy. Anything in the top 10 is really, really good right now. And I would say energy, and more energy in healthcare. To the downside, that's where things get a little slippery. Dish. Oh, you know how much I love this stock. Dish TV, PayPal, Dish, Netflix, Expedia, Bath and Body Works. Do I need to say more? Etsy, Charter Communication. That's a cable company right there. Seagate. I wouldn't do Advanced Micro right now. But right here, you've got a lot to choose from. Let me say this again. Dish, Stanley Black & Decker, PayPal, Caesars Entertainment, and Marriott too, but that's Netflix, Expedia, Bath and Body, CarMax, Etsy, Charter, Seagate. I think I've given you more than enough to work with. Now, don't expect a lot of trading action, especially with the Dow being like this. If you look at the QQQ, you will see that the NASDAQ is reaching for the skies, but if you look at the NASDAQ, you'll see that it's barely going anywhere. It can barely get it up. I mean, look at this. We're at the bottom. And look at these sectors. They're making new lows. So you've got to be very, very careful. It's not common for the Dow or blue chips to start just running away and for tech to come down. There is a lot of correlation in these markets. So we may see some upside, we may see some downside over the next few days, but overall, with the bond market pressing us down, I believe the overall market, like the Dow, is going to start moving lower once again. I think it's the fact that a lot of price discovery is already priced in to the FANG and tech stocks because they've been highlighted because of the current interest rate environment. But some of the financial stocks are still vulnerable. But again, the Dow and the NASDAQ are very correlated. So if you're seeing a market that's sold off in the, here, let me show you what I'm talking about. This is what I'm talking about. 38% above 200-day moving average on the S&P, a lot of vulnerability. The Russell 2000, 39%, a lot of vulnerability. The Dow, only 32% versus 63%, twice as many stocks. That's a huge vulnerability. Only 32% are trading above the 200-day moving average, which means there's a good chance we're going to go down. On the NASDAQ, it's 28%. So you don't have a lot of stability on the Dow Jones, even though technically it's looking really good. But look at all these small moves moving up, but the long moves are still in the toilet. So be very, 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 very cautious. And even if we do get a little rally because Republicans are leading, remember, we're probably going to be gridlocked for a long, long time. Now, before I let you go, as I mentioned before, this is a jam-packed week with earnings, CPI data, midterms, yes. Don't be shocked if we see an uptick in volatility over the next week or two. or so due to everything that's happening at once. And that's why Lance Ippolito, man, he's on fire. He's holding a master indicator class in just a few hours. Starts at 3 p.m. Eastern time. You don't want to miss it today, 3 p.m. Eastern time. Only catch it. You need to download his indicator and sign up for his class to gain access. So you got to have his indicator. But if you do, check out this masterclass. It's going to be very cool. And if you don't have it yet, click the link below or in the description to get all the details about his master indicator. You don't want to miss it. He's covering how to use his indicator, how election drama could affect specific stocks. So if you want to see which stocks are trading with a ton of volume as we kick off the elections, just click the link below. Lance has got everything on fire today, ready to go. Follow the link, check it out. Master Indicator Masterclass, 3 p.m. today. It's going to be red hot. Bye, guys. Have a great day. Remember, comment below this video, like the YouTube Wealth Press channel, and comment in the video, and I'll respond to you personally. Oh, yeah, it's like that. You can also send me an email, support@marketgeeks.com. Have a great Tuesday. Bye, guys.